Welcome to Talk Tickers. Today we're diving into Asana's Q2 results for fiscal 26. They're a big player in work management and, well, there's a lot happening there.
Absolutely. Big shifts, especially around AI and profitability.
Exactly. So we'll break down the numbers, the strategy, and, what it really means. Okay, so results first. Asana definitely delivered this quarter. They beat expectations.
Yeah, they did. Non-GAAP EPS came in at $0.06. That was a penny better than consensus.
And revenue too, right? Came in above what people were expecting.
Right, $196.9 million. Topped estimates by almost $4 million. That's 10% year-over-year growth. Still decent.
But the really eye-catching number for me was the operating margin, non-GAAP.
Oh, definitely. Huge jump there, 7.1%. That's a massive improvement, like 16 percentage points year-over-year.
Wow. And solid cash flow, too.
Yeah.
Adjusted free cash flow was, what, $35 million?
$35.4 million, yeah. It really signals they're serious about, efficiency and disciplined growth now, not just growth at all costs.
Which the market seemed to like.
Yeah.
The stock reacted pretty positively.
It did. I think there was a sense of relief, maybe. Confidence that they're steering towards profitability effectively in, well, a tricky environment.
Okay, let's unpack that.
Yeah.
How exactly are they pulling off this profitability shift?
Well, what's fascinating is how they're doing it. It's not just growth. It's profitable growth. That non-GAAP gross margin is still incredibly high, around 90%.
Which is huge. That gives them a lot of room to maneuver.
Exactly. And it means the efficiency gains aren't just, smoke and mirrors. It's coming from managing expenses carefully. R&D, sales and marketing, G&A, all down as a percentage of revenue compared to last year.
Significant drops.
Yeah, like R&D was down 16 points year over year, settling around 24% of revenue. Sales and marketing down 3 points to 45%. It's intentional.
A real strategic shift then, not just temporary belt tightening.
Seems like it. They're optimizing for profit, which is what investors want to see now. Plus, they even did a share buyback.
Oh, yeah. How much?
About $27.8 million worth. And they still have $128 million authorized for more.
So management feels the stock is undervalued, and they're putting money behind that. Disciplined capital allocation.
Precisely. Adds another layer of confidence.
And you'd expect that financial discipline to show up in customer numbers too.
Yeah.
Is it? Are they keeping customers happy while tightening the belt?
That's the key question, isn't it? And yeah, the signs pretty positive there. The number of core customers, the ones spending over $5,000 a year, grew 9% to over 25,000.
Okay, solid growth.
And even better, the really big customers spending over $100,000. That cohort grew 19% year over year, now 770 of them.
That's strong. Shows they're landing and expanding in enterprise.
Right. But maybe the most important metric is the dollar-based net retention rate, the NRR.
Which had been a bit of a worry, hadn't it?
It had dipped, but it stabilized this quarter at 96%. That's for both overall and core customers, an improvement from 95% last quarter.
So churn is slowing down and expansion is getting healthier.
Seems that way. 96% isn't, amazing historically for SaaS, but stabilization is crucial right now. It means less contraction, better stickiness, even with some hangover effects from a big downgrade they had in Q1.
And they're doing things to help that? You mentioned some initiatives.
Yeah, like these foundational service plans. They said it increases how much customers actually use their Asana seats by 20% within 3 months.
So getting more value out of what they pay for makes sense. That would help retention.
Exactly. Better price to value alignment. It's proactive.
Okay, this is where it gets really interesting for me. The AI strategy. Asana's betting big here. Dustin Moskovitz, the co-founder, talks about humans and AI teammates collaborating. The new CEO, Dan Rogers, is focused on execution.
Right.
But everyone's talking AI. What makes Asana's approach genuinely different? How do they stand out?
It really boils down to one thing, their work graph.
The work graph. Explain that a bit.
Okay, so think of most AI platforms. They start kind of blank, right? They learn from general data. Asana's AI starts with this incredibly rich, structured map of how work actually happens within a company using Asana.
Like who's doing what task, when it's due, what project it connects to, the goals, all that stuff.
Exactly. The who, what, when, where, and why. It's a pre-built model of the organization's work. So when the AI operates, it has all this context. It's not just generating text, it's embedded in the workflow.
Making its output more, predictable, trustworthy, useful immediately.
All of the above. It's designed for enterprise operations, driving team productivity because it understands the specific context. Context is everything here.
So the work graph is the brain. How are they actually putting that intelligence into the product? What are users seeing?
They've got a few key things rolling out. AI Studio is their main platform for this. And adoption seems strong. Its annual recurring revenue, the ARR, more than doubled just quarter over quarter.
Doubled. Wow. Okay, that's significant uptake.
It is. And they made it easier to try by launching AI Studio Basic, giving trial credits to all paying customers.
Lowering the barrier to entry. Smart.
Yeah. And they also launched the Smart Workflow Gallery. Think pre-built recipes for AI automation.
Ah, so you don't have to build everything from scratch.
Right. Nearly 20% of AI Studio workflows are now apparently created using that gallery. Popular in marketing, IT, ops.
And then there's teammates. That sounds like the next big frontier.
That's the vision. Intelligent digital collaborators. They're expected in public beta soon. The idea is they extend automation into fuzzier areas, things that need reasoning or judgment, not just simple task automation.
Okay, so potentially handling more complex workflows that still need a human touch today.
That's the goal, a step towards that human-AI collaboration vision.
And are we seeing real-world impact yet? You mentioned customer stories.
We are, yeah. They shared some compelling examples on the call, like Morningstar, the financial services firm. They're saving almost 15,000 person-hours a year using an AI-powered content pipeline in Asana.
15,000 hours. That translates to real money.
Over $600,000 in efficiency gains, they said, plus faster timelines for some teams.
Any others?
Yeah, a big global chemicals company. They expanded their Asana use significantly, consolidating from other tools like Jira, now using AI Studio to automate IT intake.
Faster processing, fewer errors, presumably.
Right. Then there was an NBA team using AI Studio for prioritization after a big expansion. And interestingly, a major AI foundational model company using Asana for AI safety and compliance workflows.
Using Asana to manage the development of their own AI, that's quite an endorsement.
It is. Shows the platform's capability in complex, critical processes. These aren't just theoretical benefits. It's delivering measurable value.
Okay, let's switch gears to how they're selling all this. The go-to-market strategy. Sounds like there are strengths, but maybe some challenges too.
That's a fair summary. On the plus side, international markets are doing well. Grew 13% year over year.
Faster than the U.S.
Yeah, U.S. was 8%. They specifically called out Japan as one of the fastest growing regions. Mentioned Sumitomo Mitsui Trust Bank expanding their usage by almost 70%.
Interesting. And it's not just tech companies buying.
No, that's another strength. Non-tech customer growth is robust, in the mid-teens. They mentioned Wasserman, the sports and entertainment company, standardizing on Asana, including AI Studio.
Okay, so broadening appeal. But what about the headwinds? You mentioned some dynamics.
Right. The main one seems to be at the top of funnel for their SMB, small and medium business segment.
Meaning it's getting harder to attract new small business customers.
Essentially, yes. They put it down to changes in the search landscape, partly driven by LLMs changing how people search for solutions. That's expected to be a drag in the second half.
So visibility and lead generation for SMBs is tougher. What about enterprise? Still scrutinizing deals.
Scrutiny is still there, but management said it hasn't gotten worse. So stable, but still a factor.
And are they doing anything about the SMB issue?
Yeah, they're investing in AI-driven self-service, tweaking their content strategy, using smarter engagement to try and cut through the noise, trying to adapt.
And beyond the core product sales, are they making other strategic moves? Building connections?
They are. A couple of significant ones. Getting FedRAMP in process status is big.
FedRAMP, that's the U.S. government security standard.
Yeah.
It opens up public sector deals.
Exactly. It's a crucial step to unlock that market once they get full authorization. Huge potential there.
What else?
They got listed in the AWS AI Agents and Tools storefront. Good visibility and distribution channel within the huge AWS ecosystem.
Makes sense. Tapping into where developers and IT folks already are.
Right. And an expanded partnership with MasterCard was mentioned, hinting at wider adoption in, serious enterprise workflows.
And they're showcasing all this.
Yeah, through their work innovation summits globally. Sydney and Tokyo apparently had record attendance and generated good sales pipeline. It's where they demo things like AI teammates.
Okay, so wrapping up the deep dive part, what's the outlook? What did the Asana guide for the rest of the year?
For the next quarter, Q3, they're guiding revenue between $197.5 and $199.5 million, and non-GAAP EPS of 0.06 cents to $0.07.
So roughly flat sequentially on revenue, slightly better EPS?
Pretty much, yeah. But they did raise the full year guidance.
Oh, What's the new target?
For fiscal 26, they now expect revenue between $780 and $790 million. That's 8% to 9% growth year over year, an increase from the previous range.
And the operating margin for the year also raised.
Yes, and now expected around 6% non-GAAP operating margin, up from at least 5.5% previously.
So the improved outlook reflects the Q2 beat and maybe better churn trends.
Exactly. It incorporates the Q2 outperformance and those improvements in logo churn and expansion we talked about. But it still prudently factors in those potential SUV headwinds and expects some continued, though smaller, downgrade pressure, especially from tech renewals.
Okay, let's connect this to the bigger picture. How does Asana's story, this pivot to profitable growth, the AI focus, fit into what investors are looking for in software right now?
It aligns pretty well, actually. The broader software sector, look at the IGV ETF. It's up significantly year over year.
Yeah, over 26%. Strong performance.
Right. And within that, investors are laser focused on companies that can show a clear path to profitability and leverage AI effectively. Efficiency is key.
And Asana, with its 90% gross margins and improving free cash flow, ticks those boxes, even if the top-line growth isn't, say, explosive right now.
Exactly. The market's positive reaction to Q2 suggests investors were relieved they could deliver on profit and provide solid guidance. The path to durable acceleration from here really depends on converting all that AI interest, especially around teammates, into actual upsell and maintaining that cost discipline.
And getting that FedRAMP authorization would likely help too.
Definitely a potential catalyst for enterprise growth.
All right, now for our segment. This is not financial advice, where we float an outrageous but plausible trade idea. Today, we're thinking about a long position on Asana, a DESAN, maybe using options, looking out 12 to 18 months for significant upside.
Okay, outrageous but plausible. What's the core thesis?
The thesis is basically that the market still hasn't fully grasped the potential of that work graph we discussed. It's not just a feature. It could be the foundational layer for AI within the enterprise. Q2 was good, but the real AI monetization from AI Studio, and especially Teammates, when it lands properly, could be huge. A coiled spring.
So you're betting Asana becomes less of a project management tool and more like the essential operating system for how AI gets work done in companies, the agentic enterprise OS.
Exactly. Driving massive upsells within their existing big customers and maybe landing huge new clients, especially in regulated sectors like government or finance, once FedRAMP is final, and in non-tech industries too. Places underserved by generic AI.
Okay, I see the angle. So how would you structure the trade idea? Again, not advice.
Right, purely illustrative. You might look at buying a longer dated call option, maybe something like a January 2027 call.
Yeah.
Strike price well above current levels, say $25 or $30, reflecting that big upside potential we're theorizing about.
That could be expensive, though, buying that much time and that far out of the money.
True. So to potentially reduce the upfront cost, you could maybe sell shorter dated calls against it, maybe slightly in the money calls. Creates a kind of diagonal spread.
Okay, so capturing the long-term upside while offsetting some cost with short-term premium.
Yeah. The outrageous part is really betting that Teammates isn't just incremental, but truly game-changing, that it fundamentally reshapes enterprise work, making Asana indispensable, leading to a big re-rating of the stock, blowing past current guidance.
And the plausible part. What makes this not pure fantasy?
The plausibility comes from those early AI Studio customer wins, showing real ROI. The super high gross margins mean they have leverage. The disciplined spending and buybacks show management is focused. They're building strategically.
So key things to watch would be the actual adoption rate and upsell from AI Studio and Teammates, FedRAMP finally coming through, and any subsequent big bumps in revenue guidance.
Exactly. Those would be the catalysts you'd need to see for this kind of trade idea to play out. So there you have it, our deep dive into Asana's Q2. The key takeaways: strong financial performance, better efficiency, stabilizing customer retention, and this really compelling AI story built on the work graph.
Yeah, definitely some positives, though those SMB headwinds are something to keep an eye on. But the focus on profitable growth combined with AI innovation is certainly interesting positioning.
Absolutely. And as always, remember, the trade idea we discussed is purely hypothetical for illustration. It is absolutely not financial advice.
Please do your own thorough research before making any investment decisions.
That's all for this deep dive. We hope this gave you plenty to think about regarding Asana. The big question lingers. Can Asana's work graph truly become the central nervous system for the AI-powered enterprise? Or will it be a very powerful tool, but perhaps more niche? We'll keep watching. Join us next time.